Hey, it's Chris Gately Properties, your friend in the real estate business. And have you ever wondered, how do lenders come up with mortgage rates? When you get a loan, you are not the only one taking risks. The lender is also taking risks, and interest rates are the cost of borrowing money, and it's kind of an insurance to the lender. In general, the higher the risk, the higher the cost of borrowing that money. But if you get slapped with a high interest rate, you shouldn't necessarily take it personally. The lending institution isn't taking risk on just you, they're taking a risk on the entire economy as a whole. So say you're in your juice making factory and you get laid off because the economy stinks, the lender has to consider such risk when they're making that loan. So in simplistic terms, interest rates are determined based on how much risk the lender thinks it's taking on you and the economy. Rates, however, are a little more complex than just that. A mortgage is simply a loan on a house, and a mortgage rate is the interest rate on that loan. And you can't point to one institution, such as the bank or Federal Reserve, that determines the mortgage rate. When you follow the trail, you eventually find an inaccurate and interconnected web of factors that determine the mortgage rates. One of those is the secondary mortgage market. Contrary to what people assume, bank and lending institutions that grant you your home loan don't hold on to it. Their job is to sell it to the secondary market and get money back so they can lend to other people. The bank or lender sells your mortgage to a large third-party investor, typically a mutual fund or institutional investor known as an aggregator. The aggregator then packages it up with other loans and creates a security device called a mortgage-backed security that they're able to sell. So in this way, the secondary mortgage market determines mortgage rates. But that only answers some of the question. Remember, I said there's multiple factors here. Ultimately, several factors, including inflation, the U.S. Treasury, Federal Reserve, they all affect the mortgage rates. That is because all these things are more affected on how investors are willing to pay to invest in mortgage-backed securities. So when the Federal Reserve, commonly known as the Fed, adjusts certain interest rates, especially the federal funds rate, it indirectly affects mortgage rates. But it won't really affect the day-to-day. Remember, interest rates are about risk. So they are going to be compared to things like the 10-year Treasury note, which is a guaranteed payment. So hopefully this answers a question that you may have had about how do lenders come up with mortgage rates. If you are in the market for a new mortgage, a refinance, buying a home, you name it, call us. We work with the best in the industry and we can help put you with the right lender. So that's it for today. Have a wonderful day. Take care. Bye-bye.